but we don't see policy making in that direction to address the risk that we have. And India has given returns. So people say that passive investing is the way to go. We don't think so. India is still an inefficient market where you can, create an alpha as an active investor. And when you are investing in passive, there are many changes that keep happening in the indexes. You need to be mindful of that. And passive always underperforms. So it's guaranteed underperformance in the index versus getting a possibility of an outperformance with an active manager like us. Please keep this into account that when you invest, there is a risk and return. Usually the bottom, the foundation of your investment has to be something that is safe.
So we have a very wonderful presentation. Coming up next is Thriving in Unpredictable Market, presented by Mr. Chirag Mehta, a wonderful speaker I have known in the industry, and he's from Quantum Mutual Fund. He's the CIO. So I request Mr. Chirag to please join me on the stage and help us understand the unpredictable markets. Thank you so much.
Good evening, everyone. And I know it's 6 p.m., so it's very difficult to keep you alive, but I'll sure tell you a couple of things which will help going forward. So without much ado, so there are many opportunities, and with opportunities come risk, right? And investing per se, do you think it's truly unpredictable, or can you make it predictable? Is it unpredictable, or can you make it predictable? Unpredictable. Okay. I'll share some insights to showcase how predictable it can get when you invest. So we know from the opportunity perspective, India remains the opportunity set for everyone, right? If you see, at one point in time, India was that Sone ki Chidiya, and we had lost our way through, and now we are again emerging on the global stage. India currently is about 3.5% of the global world. We will be about 14% of the global world. So when people say that, FIIs are going out, let them go out. They will come back. No investor in the world can escape something that's 14% of the world. So we will have investors come in a big way, domestic and international, that's a given. People worry about politics, right? We have seen politics be part and parcel of what India is. And we have seen across the changing colors on the India map. Sometimes blue, sometimes saffron. It goes in and out. And people worry about coalition politics. How many worry about coalition politics here? But to tell you, India has grown at 6.2% real GDP growth rate for last 40 years. And across this time, we had many governments, some single party, some coalition governments. If you were to glance through the chart, whenever we had a coalition government, our growth has tended to be higher than usual. Any reason why? We joke in office saying that, whenever we have a coalition government, the parties are busy managing each other and leave the economy alone, and it grows faster. So probably that's true, right? The chart tells us 40 years. This 6.2% real GDP growth rate will go up probably to 6.57% real GDP growth rate for next 20 years. We don't see that changing in a big way. People will tell you that India will grow at 8, 9, 10% real GDP growth rate. Don't buy that argument. India does not have the capital as yet. We don't have the infrastructure as yet to grow sustainably at that 8, 9, 10%. There'll be years when we'll grow at 8, 9, 10% one-off, but it's not sustainable. So if you want to be in India, an investor in Indian markets, you have to be more realistic. And in India, growth is important because it reflects in stock market returns. Very few economies in the world, it reflects as good as it reflects in India. If you look at the Indian market, which is right at the right-hand corner, Look at the growth and look at the returns that India has generated. Both have moved in tandem. As opposed to economies like Brazil, Turkey, Russia, China, where it has not happened that way. Growth is at a higher level and returns are at much lower level. But India, growth very well reflects in terms of returns that investors end up making. Both lines move in tandem, right? Also, the risks are important. And what are the risks that we are looking about? The biggest risk in India is to be more, you have to be more realistic and not being carried away by what's happening in India. What is the number one risk that you will see in India? Anyone? Of course, you said politics is no longer a risk. Any other risk that you think in India has? I heard unemployment. That's the right one, because we have to create close to 28,000 jobs per day for next 10 years, and that is the amount of people entering the workforce in India. And it's not that, it was yesterday's India where people are not connected. People are educated, are connected on social media, and if they don't end up getting good jobs, what would happen? Civil riots. They'll come on the street. They're not going to sit at home. So that is one of the biggest risks in India, and there are solutions for that. But we don't see policy making in that direction to address the risk that we have. And India has given returns, but it will go through its own cycles. So we have had many moods in India. In 2005, 6, 7, India was part of BRIC, right? It was a good long-term story that was put across. In 2013, India was part of Fragile 5. In 2015, India became TINA, there is no alternative. And in 2021, India is China plus one. Do you think India is China plus one? No? Anyone who thinks yes? To some extent, partly you're right, but majorly you're wrong. And I'll tell you why. So, one is to differentiate between hype, hope, and reality in Indian markets. For example, democracy. We are the biggest democracy in the world, right? So, there is a notion that BJP, Modi is important for India. We think that's a hype. It is necessary to have a stable government, for sure. India's strength is its democracy, it's a hope. But India will continue to grow at, irrespective of who is at power, India continue to grow at 6.5% real GDP is a reality. Demographics, we already saw that. We think that everyone talks about demographic dividend. It could be a demographic nightmare if it is not addressed correctly. So you have to understand the reality of it. And development, people think that India is China plus one. India will become a developed nation in 25 years is a hope. India's growth is slower than required is the reality. We should be growing much faster to address the unemployment situation that we have, but we are growing not at that pace that is required. And coming to the China plus one question, we don't think India is China plus one much. To some extent in certain sectors, yes, but majorly it is not. And this is the reason, the numbers tell you all. If you look at what is the investment to GDP percentages, we are at the same level where we were, right? China has been much higher. And look at Vietnam. Vietnam has been growing since last 10, 15 years. Look at the green line, it's moved ahead. And we also have moved ahead to some extent, but not as much. Normally, if you want to set up factories, what is one thing that comes into India is FDI. If say a US company or a European company wants to establish a factory in India, they will pour money into India. And that's reflected in FDI. And look at FDI, it's going down. And look at Vietnam, the green line, it's much higher than where we are. Look at exports to GDP. Our exports are if they are making in India and exporting outside, right? That is the case of China plus one. We are at the same level where we were. Look at Vietnam. It's gone up significantly from where it was. So if you were to ask a foreign company, if you were to set up away from China, which is the place you will be going? It will be places like Vietnam. Because it's not the US or European person setting up that factory. They don't know how to set up a factory. They're sitting in their office in US and Europe. Who is going to set up the factory is the one who is handling the factory in China, because they know how to build the factory, run the factory. And if a Chinese person were to go, apart from the visa issues, they are going to go to destinations where they are very, familiar with, right? They have people who look alike, eat alike, have habits alike. And that is the places like Vietnam. So I think this thing reconciles very well, and I think investors end up making the same mistakes over and over again, like psychologically thinking about your investments. That's not the right way, and that is where the biggest investment errors are created. This is what typically happens, and we have seen across portfolios when we talk to investors and distributors, investors, this is a typical pattern that we have seen. People buy high, sell low, and keep repeating that cycle, chasing performance. And we all know asset markets go through cycles, and this is where what I was talking about. If growth is reflected into returns, right? Look at the current anomaly that we have. The growth is much lower and markets have run up. Is market overvalued today? We think certainly is. And we will face that challenge again in the short term, of course, because we are seeing slowdown in earnings. We are seeing that FIs are pulling out. So there is some nervousness on the markets. So how do you kind of move away from the sentiments that come with flows? How do you ensure that we continue as buyers but be very rational about our buying? Earnings are growing up, but at some point in time we had a very flattish earnings and markets still were going up. So you need not be buyers during these times. You need to ensure that your earnings are reflected, which is again, we had flat earnings, now we are seeing earnings moving up. And even with these high earnings, if I were to say that markets at the end of the day reflect only one fundamental, which is earnings, you will see that, market should be very close to 75, 80,000 rupees, right, on a Sensex. But we are trading much higher today. And that is assuming a long-term multiple. Today's multiples are higher than the long-term, slightly higher than that. Probably it may correct a bit. And if you see, mid caps are trading at a much higher multiple and mid and small cap as compared to the large caps. So if you're looking for certainty in an uncertain or an expensive market, what should you be doing? Is there a way out? What were you doing when there was GFC crisis, global financial crisis in 2008? Were your investors panicking at that time? Yes? No? I think majorly were, because markets had fallen by 50%. And I am sure that investors would be panicking, seeing their portfolios fall by half. In the depth of crisis, we told our investors we are staring at a 147% upside from that time. Would you believe that or would you not believe that? Markets delivered 179%. Markets were kind and delivered 179% when we predicted 148%. Similarly, we saw COVID. Everyone was panicking. No one knew what to do. What we did, we went back to the drawing board and said, what will happen to our companies, our portfolio companies? What was the impact on earnings of those companies? And then we went and said that we were staring at a 70% upside in the depths of COVID crisis, which was around March 2020. Markets were again kind enough, gave 106% return. And this is what we have been delivering in terms of our return expectations and what actual returns that we have given. So since 2006, almost 18 years of our track record, what we have predicted and what the returns have been very much moving in tandem. Which means that what you predict means it's a more predictable outcome as compared to what you see in terms of rolling the dice. And this is what we do at Quantum. We are very fundamental investors, bottom-up investors, and we deliver a more predictable outcome to our investors as opposed to just getting you into the unknown. At any point in time, we will give you a number which you can expect 2 years out in terms of your returns. Because each company that we hold in the portfolio has a sell price. And when you see from the current price to the sell price is the upside that you can make on a stock. And if you total it for the portfolio, you have the total portfolio upside, which is nothing but the orange line. An orange line, what we predicted and what we delivered moves in tandem. And this is not something that is coming out of wild. It's a process-driven approach. We think whatever the value of that company is 2 years out, assuming it is 100 rupees, we want to buy that company at 75 rupees or lower. When we buy that, it's a 33% upside, which is about 15.5% CAGR return that we end up making on that stock. So if we are making that 15.5% return, then probably that is the outcome that you get in what you saw in the previous slide. Just to understand one thing about investing, one is returns predictability and what kind of companies that you end up investing when you invest. So there are many companies where the governance is at risk, and how we evaluate that is, shake someone's hand and ensure how many fingers you get back. If you don't get 5 fingers, we don't invest into those companies. So any kind of company which has governance aspect, we don't invest into those businesses. So people say that passive investing is the way to go. We don't think so. India is still an inefficient market where you can, create an alpha as an active investor. And when you are investing in passive, there are many changes that keep happening in the indexes. You need to be mindful of that. And passive always underperforms. So it's guaranteed underperformance in the index versus getting a possibility of an outperformance with an active manager like us. Please keep this into account that, when you invest, there is a risk and return. Usually the foundation of your investment has to be something that is safe, that is liquid, that is predictable. And when investors build their portfolio, is usually an inverted pyramid that we see on the charts. So with that, we think India is a great opportunity. You need to invest with a lot of realistic allocation and ensure what you see and what you get is not the same thing. So invest something where it's more predictable, as well as ensure you get your 5 fingers back when you invest. With that, thank you so much. Sorry to run a little over time. Thank you so much.